Welcome back to Concept Learning. In this tutorial, we are going to look at how good is a performance in a business. The performance of a business can be analyzed from various ratio analysis. One of the common ratios is profitability ratio. What is profitability ratio? It measures the efficiency with which your company turns business activity into profit. It attempts to measure the firm's success in generating income. It is basically an indicator which helps to understand how well a firm is performing in terms of its ability to generate profit. The performance of a business can be analyzed from this indicator of profitability ratio. It measures a company's ability to generate earnings relative to sales, assets, and equity. The definition of profitability ratio helps us to compare income statement accounts and categories to show a company's ability to generate profits. Now, when we talk about profitability ratio, there are mainly three profitability ratios. First is return on capital employed, second is gross profit margin, and third is net profit margin. Let's come back to first return on capital employed. When we talk about return on capital employed, from where will we come to know how much is the return on capital employed? For this, we need to see the balance sheet of the company. How do we calculate return on capital employed? The formula is net profit over capital employed multiplied by 100. Regarding gross profit margin and net profit margin, we need to see the income statement of the company. The gross profit margin is calculated gross profit divided by sales revenue multiplied by 100, and net profit margin formula is net profit divided by sales revenue multiplied by 100. Let us take one example of return on capital employed and see how the calculations are done. Let's say there is a company ABC. It has got a profit of $280 million in 2013. It got the capital employed $1065 millions. Now we need to calculate the return on capital employed. The formula we have already seen, it is net profit divided by capital employed multiplied by 100. If we do the calculations, we will get our ROC as 26.3%. This means higher percentage ROCE means managers are earning profit. Higher the percentage, higher is the profit margin in the company. And secondly, it also says that managers are able to run the company efficiently with good profit. This is the calculation of return on capital employed. Thank you.